According to Benjamin Graham, the father of value investing, successful investing is about managing risk, not avoiding it. Risks are inherent in any investment strategy. While it's not feasible to completely remove investment risks, there are steps you can take to manage them. In this video, we'll share 5 effective strategies to minimize investment risks in your portfolio.
By the way, if you like this type of content, be sure to hit the like and subscribe button.
Do your research. Successful investment requires knowledge of market dynamics and an effective investment strategy. Understanding how the market works can significantly reduce your investment risks. When investing in stocks, for instance, it's important to evaluate the company's growth, debt-to-equity ratio, management, and other indicators of its potential for success, rather than making investment choices based solely on someone else's advice. Know your risk tolerance. Risk tolerance is the extent to which an investor is willing to take on the possibility of losing investment funds. When making investments, it is important to assess how much risk you are comfortable taking, which is usually based on factors like age, income, financial obligations, and others. For instance, an investor in their late 50s who is married and has children is less risk tolerant than those in their mid-20s who are single and have fewer financial commitments. Younger investors in general are more willing to take risks than their senior counterparts. In comparison, investors close to retirement age tend to prioritize investing in fixed income investments because of their lower risk. Diversify your investments. Diversification is another effective strategy for reducing investment risks by spreading capital across various asset classes. Diversifying your investments protects you against market fluctuations. You can mix equities, bonds, and cash in your portfolio and allot a percentage of your capital to each asset. For instance, you can allocate 30% of your investment capital to stocks, 25% to insurance, 25% to certificate of deposits or CDs, and the remaining 20% to emergency funds. A loss or lower return from one investment vehicle may be mitigated by the other. Spreading your capital across different categories of an asset is also another way of diversifying. For example, you can diversify your investments across stocks of multiple industries such as real estate, consumer goods, transportation, banking, and others. If a certain industry in your portfolio is underperforming, there's still a chance that others may thrive. Suppose the banking industry is struggling, the real estate market, on the other hand, can be growing. Maintain liquidity. An unexpected financial crisis might occur at any time. Having not enough cash on hand during such cases might force you to withdraw some of your investments, regardless of how the markets are doing. If you pull out your assets during a down cycle, you might incur significant losses. Such risk can be mitigated by maintaining liquidity in your portfolio. Having an emergency fund, typically 3 to 6 months' worth of living expenses, is one way to ensure you have enough cash during unexpected financial storms. With a safety net of liquid assets, you can make long-term investments and avoid incurring losses caused by market volatility. Monitor your portfolio. Monitoring and reviewing your portfolio's performance is essential. Just because you make long-term investments doesn't mean you can ignore them. Your asset allocation from last year may no longer be optimal in the current market conditions, which can potentially increase investment risks. Thus, it is best to evaluate your portfolio regularly. Once or twice a year is sufficient for reviewing long-term investments. Rebalance your portfolio if an asset has been underperforming for an extended period of time. Making investments can help you secure your financial future. But knowing the risks associated with investing is also essential to making smart investment choices and decisions. By taking a strategic approach, you can reduce investment risks and increase the chances of achieving financial success.
We hope this animated video has helped improve your financial literacy. We do our best to provide actionable tips that are easy to digest and implement in real life. If you want to see more of these videos, please leave a like and subscribe to our channel. Also, comment what you've learned and comment what you want to learn about money in the future.
Thank you so much.
That's more than enough to help us grow and sustain our production expenses. See you in our next video.